Last week, we talked about who owns the strait and how, for the first time in the history of modern energy trade, a country didn't just try, but actually put a toll booth in the middle of the ocean, and what it meant that the President of the United States, for about 24 hours, thought that sounded like a pretty good idea. This week, I want to zoom out. Because the strait is the surface story. The deeper story is about what happens when the world suddenly realizes that it can't depend on Middle Eastern energy anymore. Not just this week, not just this conflict, structurally and permanently. The world needs an alternative, and here's the uncomfortable part. The alternative already exists. It's built, it's scaled, it's ready to export, and almost none of it comes from Taiwan. Taiwan makes the chips that run the AI that's supposed to power the future, but the energy that future runs on, that's a different story entirely. And nobody is talking about the gap between those two sentences. Well, we're going to today. Hi, you're listening to Beyond the Reefs, a show produced by Radio Taiwan International. Here we talk about socio-economic issues that are faced by Taiwan and their broader impact around the world beyond the reefs of this island nation.
Taiwan's stock market is climbing to levels not seen in 25 years, with investors pushing ahead despite global uncertainty. The benchmark TAIEX surged on Wednesday to a new intraday high. Chip giant TSMC led the rally, also reaching a record peak. Margin debt, that's money investors borrow to buy stocks, has risen more than $13 billion, the highest since September of 2000. Analysts say the surge is being driven by AI demand, despite geopolitical risks such as the Iran war.
2026 is already shaping up to be a strong year for TSMC. The company posted record profits at its quarter one earnings call this Thursday, driven by huge demand for its most advanced AI chips. TSMC says net profit jumped 58% in the first quarter, beating expectations. It made about $18.2 billion from January to March, its highest quarterly profit ever. That growth is coming from its most advanced chips, including 3nm technology and packaging used in AI. Analysts say demand is now outpacing supply, with major clients like Nvidia and Apple relying on TSMC. But despite the strong results, some warn the company's stock may not keep rising. So even as earnings surge, short-term momentum could slow. Still, TSMC's rally has helped lift Taiwan's broader market. Taiwan's total market capitalization has now topped $4 trillion, overtaking the UK to become the world's 7th largest. At the same time, the company is ramping up spending overseas, raising concerns about rising costs. It plans to invest up to $30 billion this year into its global operations, part of a wider $165 billion effort to build up chip production in the United States. That raises questions about margins and profits going forward. So while demand for AI chips remains strong, rising costs and global expansion efforts will be key considerations to watch out for this year.
Now, before we get to the meat of the show this week, here's what's been happening in Taiwan. Last week on the show, we asked who owns the strait and whether Taiwan was paying enough attention to the answer, and this week, the island gave us some data points worth sitting with. TSMC, semiconductor manufacturing giant from Taiwan, reported its Q1 2024 earnings on Thursday, and the numbers were striking. Revenue came in at roughly $35.9 billion. That's up 35% from a year earlier. Net profit hit $18.2 billion, up 58% year on year. It's a record on every measure that matters. Chairman C.C. Wei upgraded the full-year revenue growth forecast to more than 30%. And if you needed a cultural timestamp, Time magazine named Wei one of the 100 most influential people in the world this week, with a profile written by NVIDIA CEO Jensen Huang, who calls TSMC indispensable. And that's not marketing language, that's a supplier dependency disclosure. Meanwhile, an energy expert speaking at a Taiwan forum put a number on something Taiwan doesn't like to say out loud. Taiwan imports 69.6% of its crude oil from the Middle East in 2025 and 33.7% of its LNG from Qatar alone. That's the setup. Now let's get into it. We're going to start with what everyone is celebrating because the celebration is real. TSMC just posted the best quarter in its history, gross margin of 66.2%, operating margin of 58%, advanced nodes 3 nanometers and below now account for 74% of total revenue. High-performance computing, which is essentially just another way of saying AI, now accounts for 61% of revenue. A year ago, it was closer to about 50%. The year before that, it was actually smartphones. That structural shift is the real story behind the earnings report. TSMC has fundamentally stopped being a consumer electronics company. It's an AI infrastructure company that also happens to make chips for your phone. And the build-out isn't slowing C.C. way. Announced this week that TSMC is expanding 3 nanometer capacity simultaneously in Taiwan, Arizona, and Japan. New fabs, new production lines, capital expenditure for 2026 is tracking towards the upper end of 52 to 56 billion US dollars range. And Wei said that over the next 3 years, total capex will exceed the previous 3 years total. That's not consolidation, that's acceleration. And at the same time, Taiwan's stock market crossed a threshold that would have seemed implausible about a decade ago. Total market capitalization surpassed the UK this week, making Taiwan the 7th largest equity market in the world. An island of 23 million people ranked above a country of 67 million with centuries of financial infrastructure. The semiconductor premium has done that. So yes, the celebration is real. TSMC is extraordinary. Taiwan's position in global technology is genuinely remarkable. And now, here's the complication. Every chip TSMC makes requires electricity, a lot of it. AI chips, the high bandwidth memory stacks that go into NVIDIA server cabinets require more electricity per unit than anything the semiconductor industry has produced before. And AI chips aren't just made in fabs that use electricity. They go into data centers that use even more of it. The Stargate project alone, the US $500 billion US dollars AI infrastructure build-out that began full construction this year and runs through 2030, is predicted on having somewhere between 5 and 10 times the current US data center power capacity available by the end of the decade. That power has to come from somewhere. And this is the part of the AI story that doesn't get enough attention. We talk about chips, we talk about models, we talk about which company is winning the software race. We don't talk nearly enough about electrons. Global AI capital expenditure is projected to hit $1 trillion US dollars in 2026, and that's up from $270 billion in 2021. That's 5 years and nearly 4 times. The constraint on all of that investment, the single thing that could slow it down, isn't fabrication capacity, it's power supply. And power supply is constrained by something you might not expect: interest rates. Building new electricity infrastructure, power plants, grid upgrades, transmission lines is extraordinarily capital intensive. It requires long-term financing. When interest rates are high, the cost of that financing goes up. Projects that were viable at 2% rate look very different at 5%. Some of them actually don't get built. So we have this situation where AI demand is pulling electricity infrastructure investment, but high interest rates are pushing back against it. And the reason interest rates are high, the reason the Fed can't cut, is that inflation is running above target. And the reason inflation is running above target is partly energy prices. Oil at $94 a barrel, LNG in Asia at $18 to $20 per unit, compared to less than $3 in the US. Now follow that chain back to its origin, and you end up at the Strait of Hormuz. Taiwan is caught in the middle of this loop. Its chips feed the AI build-out. The AI build-out need power. The power is expensive to build because rates are high. And rates are high because energy is expensive. Oh, and energy is expensive because of a conflict in a strait that carries 80% of the crude oil and nearly 90% of the LNG shipped to Asia. And 69.6% of Taiwan's own crude oil comes from the Middle East. So let's sit with that for a bit. Taiwan, the company that makes the world's most advanced chips, the company Jensen Huang calls indispensable. The companies that Time magazine just said is one of the most important on Earth is structurally exposed to a maritime choke point it has zero ability to influence. Now here's the country that chose a different path, and I want to be precise because it's easy to overstate. China didn't choose differently out of foresight alone. China chose differently because it was pushed. Western sanctions limited China's access to advanced semiconductors. The technology decoupling that accelerated after 2018 forced China to invest heavily in the parts of the technology stack where it could still compete. It poured money into electronic vehicles, into solar energy, into wind, into battery storage, into advanced nuclear power. And then the Middle East exploded. Well, for the lack of a better term. And every single one of those bets paid off at the same time. China's EV export in March 2026 up 82.4% year on year, 74,000 vehicles in a single month. To put that in scale, Taiwan's entire annual car market is about 40,000 vehicles. China exports nearly double that in 1 month. Domestic EV sales are actually down. The internal market is brutally competitive. Companies are being squeezed out, but the export machine is running hard because the rest of the world suddenly needs what China built. It's not just EVs either. China controls the dominant position in solar panel manufacturing, in wind turbine components, in lithium battery supply chains, in battery storage system, in the rare earth minerals that go into all of the above. In advanced nuclear reactor commercialization, where China is moving faster than the United States or France. Hydrogen is the one exception. China has a majority position but not dominant. Everything else, China is first, and it's not even close. So when the world looks at $94 per barrel of oil and asks, what do we do about this? The answer in almost every clean energy category runs through Chinese supply chains. And we have learned firsthand just how important that supply chain is. Taiwan builds semiconductors that feed the AI industry, and just by being a part of that supply chain, its stock market has hit record highs to surpass the UK. Imagine China's position, having control over a part of the supply chain of all the industries we just mentioned above. The world isn't making this energy transition for environmental reasons anymore. It's making it because a choke point in the Persian Gulf made fossil fuel dependence feels like a loaded gun pointed at every economy in Asia. And the technology required for that transition is almost entirely controlled by one country, China. And Taiwan can't get close to that. Taiwan couldn't do what China did. The constraints were different. Taiwan is the democracy with a small land area, limited natural resources, and manufacturing economy that was already world-class in semiconductors. The comparative advantage was always in chips, not in panels or turbine or battery packs. There wasn't a policy decision to skip clean energy investments. There was a structural reality that made it very hard to dominate these sectors the way a continental economy with massive state capital allocation can. So there's also a more uncomfortable dimension. Taiwan's energy policy has been tangled in domestic politics for years, particularly around nuclear power, which was phased out, then partially reversed, and around the pace of renewable build-out. The result is an energy mix that still leans heavily on fossil fuels, and those fossil fuels come overwhelmingly from the Middle East. Meanwhile, the global pattern is clear. The countries that invested heavily in clean energy infrastructure over the last, let's say, decade even if they did it for industrial policy reasons, even if there was overcapacity and brutal price wars, are now sitting on assets the whole world needs. Taiwan isn't one of those countries. Okay, I should say Taiwan is one of those countries, but not enough. What Taiwan has instead is something genuinely irreplaceable: the ability to manufacture the chips that make AI work. That's real, that's not going away, but it creates a very specific kind of vulnerability. TSMC's entire business model depends on AI infrastructure continuing to be built. That infrastructure depends on power being available, and the transition to cleaner, more stable power, the transition that reduces exposure to Middle East energy shocks, run primarily through Chinese supply chains. Now, that is not an argument that Taiwan is in trouble, it's an observation about interdependence. The world's most important chip company and the world's most important clean energy supplier are on the same small planet, and their fortunes are more connected than either side wants to acknowledge. So here's the dimension that complicates everything else. TSMC's Q1 earnings report contained a line that deserves more attention than it got. CFO Wendell Huang was asked about the impact of the Middle East conflict on TSMC's own supply chain, specifically on special chemicals like helium and hydrogen, which are critical to semiconductor manufacturing. And his answer is TSMC has diversified its sources, maintains sufficient inventory, and expects little short-term impact. Well, that's a reassuring answer, and it's probably accurate for the short term. But sit with the question for a moment. The world's most advanced semiconductor manufacturer, the company that makes chips for NVIDIA, Apple, AMD, and effectively every AI company on Earth, depends on specialty gases that are partially sourced from the region whose instability is driving up energy cost, constraining rate cuts, slowing power infrastructure investment, and forcing a clean energy transition that China is best positioned to supply. It's not one vulnerability, it's a stack of them, each one resting on the one below. TSMC is extraordinary, we're not doubting that. Taiwan's position in the global technology economy is genuinely remarkable. C.C. Wei deserves to be on that Time magazine list, yes, Jensen Huang isn't wrong about that. But indispensable is not the same as insulated. And the energy infrastructure that the world depends on is being built in a world where the clean alternatives are overwhelmingly Chinese. The fossil fuel supply is geopolitically fragile, and the financing environment for new power generation is constrained by the very instability that made the transition urgent in the first place. Taiwan's chips light up the AI economy. The question nobody's asking out loud enough is what lights up Taiwan? So here's where we land. Taiwan just posted the most impressive earning quarter in its semiconductor history. Its market cap overtook Britain's. Its CEO is on the cover of Time. By every conventional measure, this is a triumph. But the infrastructure that triumph depends on, the power that AI needs, the energy Taiwan imports, the clean technology transition the world's being forced to make runs through supply chains Taiwan doesn't control, and in many cases can't easily access. Politically, Taiwan is currently at a standstill with China. Politically, Taiwan's incumbent administration isn't really on speaking terms with China, so we'll see where that goes. Maybe that's fine. Maybe TSMC's position is so strong that none of this touches it. Maybe the clean energy transition happens fast enough that the power problem solves itself. Or maybe indispensable has a floor that nobody has inspected yet. Thank you for listening to the show. I'm Joey Cho. Tune in next week to find out more about socioeconomic issues that are faced by Taiwan and their broader impact around the world beyond the reefs of this island nation.